Six Flags Entertainment is one growth stock down 64% that I think you might regret not buying on this dip. I'm excited to share with you why I think that's the case. That's what I'm going to do in this video, so stay tuned until the end. You're not going to want to miss why this growth stock is a buy.
So
Starting with Six Flags annual revenue going back 10 years, you see the company was on a nice growth trajectory up until, of course, the pandemic when theme parks were forced to shut down temporarily. Revenue collapsed from over $1.4 billion down all the way to 400 million, and then it rebounded back up close to and up to 1.358 billion as of its most recent update. Now, keep in mind the company, if as you look at this chart, it hasn't fully recovered to pre-pandemic levels of attendance because not as many people are going to the theme park as there was before the outbreak. However, Six Flags has incorporated price increases across the board, so people are paying more per visit and spending more per visit. This is good news for investors because this is not just something that's happening with Six Flags Entertainment. This is happening industry wide. The Walt Disney Company has increased prices on its theme parks. Universal Studios has done the same thing. So price increases industry wide makes Six Flags operate in a less competitive industry because consumers can't say, oh, well, Six Flags is too expensive, let me look to something else. Well, if you think a ticket to Six Flags is too expensive, wait until you see how much a ticket for the Walt Disney theme park is. So, competitively speaking, Six Flags is in a good position and it's benefiting from consumers unleashing this pent up demand for away from home experiences. This is where consumers are spending more and more money on nowadays, and they're looking for ways to get out of the house and do things outside of the house. And that's understandable. We were stuck at home for it seemed like an eternity. So we want to get out. We want to do something outside. We don't want to be at home anymore. We're tired of streaming content as much as we were during the early days of the pandemic. We want to get out, do something outside, and Six Flags stands to benefit from that trend, which is likely to persist at least throughout 2023 and for much of 2024. And so, similarly, you look at Six Flags cash flow from operations in the trailing 12 months, it collapsed in the aftermath of the pandemic. It recovered very quickly, but it's still not back to pre pandemic levels. It's still recovering back up to that level. So, it's got room to get back up there, which I fully expect it will as people get out more, as the fear of COVID 19 continues to diminish and economic reopening momentum sustains. People start to not be afraid of contracting COVID 19. They're going to want to go out more, and we're already seeing that, and that's likely to persist, and that's likely to give Six Flags a further boost in cash flow from operations, which is already in the healthy positive area. It's already got 269 million in cash flow from operations in the trailing 12 months, significantly better than the lows of negative 250 million. And at its peak, it was generating close to 500 million in cash flow from operations. So a healthy cash flow generating company. Similar with its operating income over the trailing 12 months. Look at that nice upward trend there in operating income before the outbreak caused it to collapse. And now it's recovering back up here. 380 million in operating income in its trailing 12 months, but again, still not completely recovered to pre-pandemic levels, which again, I fully expect it will because consumers are still unleashing pent up demand for these types of experiences, theme parks, restaurants, bars, travel. That's where the majority of consumers are shifting their spending away from things like laptops, smartphones, and tablets, and big screen TVs and furniture. It's going away from those categories into these away from home categories like theme parks. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And the last reason I'm going to give for why you might regret not buying Six Flags stock right now on this dip is because of the attractive valuation. So Six Flags is trading at a forward price to earnings ratio of just 11.35. That's near the lowest it's been going back to January of 2022. And this is likely due to the fears of the company's decrease in revenue, cash flow, and profits as a result of the pandemic, and the company has still not recovered back to full strength. So while it's still less than full strength, investors are a little bit worrisome about Six Flags Entertainment stock. Also, because of a fear of a potential economic recession, one of the things you'll do a lot less of if there's a recession is discretionary spending, like going to a theme park. So Six Flags does have some risks to it as a result of a recession, but on the flip side, it's got that tailwind from consumers unleashing pent up demand. So even if there's a recession, that downward force is going to be met by the upward force of people still wanting to get out and do stuff away from home because we spent so many years cooped up indoors. So those two forces are likely to counterbalance each other, but it remains to be seen which one will be stronger if there is indeed a recession. All right, so that's all I've got for this video. I picked another video that I think you're going to enjoy that's popping up on your screen right now. I suggest you click on that. I think you're going to enjoy it, okay? So thank you so much for watching, and I hope I'll see you in that next video that's on your screen right now.